first activity in Unit 2, Accounting for Assets, goes over forms of payment. In your study of accounting to this point, you have accounted for the payment of goods and services with either a short-term accounts receivable or cash. In this activity, you will learn about the use of credit cards and debit cards as a form of payment. First, we will look at credit card sales. There are three parties involved when credit cards are used in making a sale: the credit card issuer, the retailer, and the customer. The retailer pays the credit card issuer a percentage fee of the invoice for its services. From an accounting standpoint, sales from bank cards, Visa and MasterCard, are treated differently than sales from non-bank cards such as American Express. Sales resulting from the use of Visa and MasterCard are considered cash sales by the retailer. And the reason this is so is because as soon as the retailer gets that approval for that sale, that money is guaranteed from the bank that they will pay whether the customer who owns that Visa or MasterCard pays or not. These cards are issued by banks, and so they immediately debit bank with a sale like that. One example is on this slide. Anita Ferrari purchases a number of compact discs for her restaurant from Karen Kerr Music Company for $1,000 using her Royal Bank Visa card. The service fee that the Royal charges is 3.5%. So the journal entry to record this sale is debit cash, the $965 that we are actually going to get from that sale, debit credit card expense, 35, 3.5% of 1,000 is 35, and credit sales 1,000. And the explanation is to record Visa credit card sale. When it is a non-bank card sale, such as American Express, I think there's a Diners Club of America, these are reported as credit sales, not cash sales, because the retailer isn't guaranteed the money until the customer pays and American Express then sends the money to them. Unlike a Visa or MasterCard where the payment is guaranteed right away. When you're recording a non-bank card sale, you treat it as accounts receivable to start off. So in this example, Kerr Music Company accepts an American Express card for a $500 sale. The service fee that American Express charges is 5%. So we're going to debit accounts receivable for the amount that we're actually getting from this sale, debit credit card expense, the 5%, which is $25, and credit sales, $500. When American Express actually pays us that money, at that time, we debit bank and credit accounts receivable. We don't record the sale again because we already recorded it on July 31st. The last form of payment is a bank debit card. And in this example, Kerr Music Company accepts debit card for a $500 sale. The service fee that the bank charges is 2%. So you would debit bank $490, the actual amount you would be getting. Debit card expense will be debited $10 and sales credited $500. I'm not sure if any of you have ever been in a store where they say cash, if you pay with cash, then the amount you pay is lower. And the reason some retailers do this, they encourage cash payments, is because every other type of payment, they actually have to pay the bank a service charge for your sale. Good luck with Activity 1, everyone.